How about this? China's central bank last night cut its key mortgage reference rate by a record amount as it ramps up efforts to stem a prolonged property crisis, right? The People's Bank of China announced Tuesday that it would cut its 5-year loan prime rate, the LPR, from 4.2 to 3.95%. Now, that's 25 basis points, and that 25 basis point cut to the 5-year LPR is the biggest reduction the central bank has made since it revamped its LPR system in 2019. The latest cut was also the first reduction to the 5-year LPR since June of 2023. Now, China's economy has been hobbled by a real estate downturn since 2021, when a government crackdown on developers borrowing urged on a liquidity crisis in the sector. Now, the crisis has triggered widespread protests by unpaid construction workers, buyers of unfinished homes, and frustrated investors facing financial losses. It's also spilled over to the country's massive shadow banking industry. Now, what effect, if any, does this have on the U.S. and our markets over here? It's hard to ignore an economy that's almost as big as ours. My next guest is a markets man from Chicago. Please welcome into the show, Craig Bolanos, CEO and co-founder of the Wealth Management Group. Thanks for taking the time, Craig. All right. Okay, 25 basis points to us, no big deal, but to a place that usually does 5, 10, or 15 basis points, 25 basis points raised some eyebrows. Reuters had reported that they had a survey of 27 market participants in China, and 25 of them thought it would be a 15 basis points cut. So in percentage terms, it surprised a few folks, even though it's not that big.
Scott, I'm smiling because what do you and I say every time we get economic data?
Bet
or in this
over.
game, you bet the over every single time. Are you kidding me?
Yeah.
So you're right. This is significant. It is meaningful. It's China's way of acknowledging, though, that they have moved past some of the banking sector areas. And remember, just like you don't fight the Fed, you might not want to fight China. I mean, literally, their stock market has been anything but on fire. It hasn't been a place to attract capital. But if we get some stimulus, and next thing you know, you get a larger stimulus plan coming from the Chinese president, if that were to come, all of a sudden, people got to take a look at what could be up and coming, and maybe capital starts going into China as opposed to fleeing China. And that'll be an important decision for asset allocators around the globe.
All right, we'll get a load of this segue then. See, I think you're right. And when I saw that this morning, I thought it was definitely stimulative, right? I mean, a 25 basis point cut for the LPR is a decent deal. And then I thought to myself, well, I automatically expected our markets to be up on the back of that because they only want to go higher on any stimulative news, rate cut news, something like that sort. Even though it's not here, it's obviously over in China. But we weren't higher. Is it because people now took 3 days off and thought, CPI and PPI were really worse than we thought, and we should probably start thinking about that? What was the reason you think behind it?
Well, I think the reason you didn't get a broad-based rally in the U.S. is we are still repricing for less Federal Reserve cuts than people had anticipated in October. And remember, our entire market, when you and I talk about the market, we're talking about cap-weighted indices. I mean, the S&P 500 equal weight did much better than the cap-weighted indice last week. I see this entire thing broadening out in the United States. I think we've temporarily run into an air pocket for the Mag 7. That doesn't mean they're not investable. Of course they are. It just means the valuations are too ripe. And when those valuations are too ripe, those 7 stocks are going to dominate our cap-weighted indices and not provide the gains that we otherwise would have had today. But other pieces of the market are doing their part.
Okay, real quick, I want you to explain that because I think that's a great point to the viewers watching about this difference between a very narrow sector doing all the heavy lifting for the indexes versus then moving some of that money out into the broader index, which would be going away from cap weighted to equal weighted. Can you explain that in 20 seconds so that they understand?
Yeah. So in 20 seconds, you've got 2 choices. If you want to be in the S&P, you can be in the traditional cap-weighted indices where the securities that have the largest price are going to dominate the point moves, meaning, Apple, Nvidia, Google, Tesla, they're going to control whether the S&P 500 is up or down in a day. But in the equal weight, all companies are created equal. So Walmart, which is having a nice pop today, Vizio, that's having a nice pop, in the S&P 500 equal weight, each company is worth 1/500th of the index. Each company contributes on an equal basis. I think it's a broader representation of what happens for great companies in America.
All right, so I bring that to the folks that watch this show. We look at the Dow 30 stocks, right? But then we go to the 500, which is a little bit more of a broader, well, it's a lot bigger of a broader index than 30 stocks. And you've kind of done it one step further. You've gone away from the cap-weighted to equal-weighted 500, which is an even more broader index. And that, you think, is going to do better than just kind of hanging out in the Magnificent Seven or artificial intelligence stocks this year?
I think when I look out over the next 90 days, I think the equal weight version in the next 90 days likely produces better results than the cap weighted version. I would also make an argument that at some point in time, if you're an investor and you're a little bit worried about betting your portfolio on the gains just in 7 securities, then taking an equal weight approach for a part of your money is going to make an awful lot of sense for long-term investors.
Real quick, we have about 30 seconds, but if you see short-term rates back up over 5%, do you move any capital that way, or are you 100% still all in the indexes?
Well, you know what? I'm looking at that 10-year treasury in particular, and I start to get a little nervous. Not as nervous as a long-tail cat in a room full of rocking chairs, because I don't think we're printing a 5 anytime soon. Right. But those treasury yields have been bumping up some very significant resistance. And if we go ahead and print closes 435, 440 and higher, I think you are going to have some money come out of equities, flow into risk-free assets for a period of time. But Scott, just remember, there's so much FOMO, fear of missing out, money that's on the outside. I think that provides some currency and is going to keep getting stocks to go higher as we plow through 2024.
All right. Awesome stuff. Great content as usual. Thank you very much, Greg Bolanos. He's the co-founder and CEO of the Wealth Management Group up in Chicago. By now, you know I've got my